Welcome to Kitchen Table Finance, the podcast where we serve up bite-sized pieces of financial advice to simplify your money and your life. Join your hosts, David Shotwell and Nick Nauta, and let's get started.
Hey, Dave, how you doing today?
I'm doing great, Nick. It's a beautiful summer morning, sunny out there. I see you're rocking the alumni T-shirt today.
Oh, yeah.
Yeah. Proud Northern Michigan Wildcat. Yeah. Yeah.
We are, well, by the time this podcast drops, we'll probably have already embarked on our annual trip to Marquette to relive the old glory days.
Good.
As we do every year, one of the highlights of summer. So, speaking of highlights, Dave, we are back at it again with some more required minimum distribution stories. This time focusing on the state of Michigan edition.
Yes.
True disclaimer, there's not a huge difference between state of Michigan and Michigan State or any other RMD scenarios. There are some minor differences that we'll go over, but it's always good information to kind of go through. And it's a big talking point for people.
It seems like no matter how much we talk about some of these topics, they tend to keep coming up in conversations. So,
for sure. So with that being said, I want to give us a brief overview again of what exactly an RMD is.
Yeah, required minimum distribution. No magic there, but it's one of those jargony things you see tossed around in investment circles all the time. Essentially, it's the idea that at some point, and right now it's age 73, you will be required to take funds back out of your tax-deferred retirement accounts and pay some tax.
Yeah. So a little bit of good news is if you're born before 1960, that's going to be pushed back out again to 75. But either way, this day will come where the IRS would like to recapture some of those taxes that you've been deferring, and they do that through required minimum distributions. And so, one of the things that's actually been rolling around the news lately is a potential plan to change the amount of money that you can have in your IRA. And kind of the theory behind that is these IRAs, Roth IRAs, are getting so big, and the tax deferral is extending out. And so it's kind of one of those things. And, whether or not that happens is really kind of a moot point. But the fact is, we're getting a lot of money in these IRA accounts, which means RMDs are going to be larger and larger.
Right.
When you get to that point.
Right. Yeah. I don't want to get into the whole political discussion right now because with most of these things, it's not a law until it's a law, right?
Yeah.
So,
well, that's one of the things I learned from you early on, Dave, was, we could talk ad nauseum about the shoulda, coulda, wouldas of what they potentially might do, but until it actually becomes a law, there's generally not a lot you should be doing. So.
Right. So how required minimums distributions get calculated, what it's based on, is still a real confusing point for a lot of people. So,
for sure. You want to go give us the specifics of how to calculate those?
Well, so the year that you need to begin required minimum distributions, and as we just noted, it's 73 right now, but for those born after 1960, in 1960 or after
1960 or later.
Okay, thank you for clarifying that. It will be 75. In that year, there'll be a formula based on your December 31st tax deferred account values.
Yep.
And a formula that includes your age, life expectancy, which will calculate out your required minimum distribution.
Yeah. So basically you take that value and divide it by your life expectancy. So just to give you an idea, at 73, the RMD factor is 26.5 currently.
Yes.
Right. So if you had $1 million balance at age 73 on December 31st of the previous year, you'd have an RMD of about 37,700 or so.
Yeah.
For some context.
So about 3.75%, a little less than 4%. And I think where a lot of confusion comes in, people seem when we talk to folks in their 60s or early 70s, they're afraid that required minimum distribution is going to be a lot higher percentage
Yeah.
of the account that it ends up being. But that's still, as you note there, with account balances being what they are, can add up to some big dollars and some big tax impact.
Yeah, what's interesting, we have a chart here. We'll try to post it in the show notes, but if we're just assume a 5% growth and taking your RMDs every year, by the time you hit 82, you've got about similar starting balance, a little over $1 million
Right.
at that point, but you're up to, 10 years later at 83, you're up to about 60,000. So, almost $25,000 more in that scenario if you
Right.
averaged 5%.
Right.
So, that it goes up obviously. And if you did better in the market than 5%, it's going to go up more because your balance is more, but it doesn't really start to ramp up until you get into like the late 80s and 90s when your, life expectancy is much shorter and if your balances are still high. So, but certainly something worth planning out and thinking through because it does, if you're going to add another 50, 60, $70,000 to your taxable income in any given year, you potentially might be, it's not necessarily just only ordinary income tax.
Right.
There's some other things that may impact you, things like IRMA, or,
Yes.
more taxation on your Social Security, lots of different factors
Right.
that you might. And so I think the biggest takeaway again is just think through and start planning out some of those scenarios and seeing how it's going to impact you and if there's things that you should be doing to kind of mitigate some of that.
We should maybe mention first that in the first year that you're required to take a distribution, you actually have until April 1st of the following year to take that distribution. Meant to more for an administrative thing to like help people not miss it.
Right.
A lot of people look at that as an opportunity to delay, but we always caution against that because you're going to be required to then in that second year, because from then on, the deadline is December 31st of every year.
Right.
So if you were turning 73 this year, you could delay until April 1st of next year, but then you would have to take this year's and next year's in 2027, effectively a little more than doubling that. Plus, it also makes your 2027 distribution bigger because your account balance will still include the distribution you should have taken this year. If that makes sense. So unless it's like a really weird situation where other income was changing drastically, we generally advise people not to delay that.
It's pretty rare that we get into one of those situations. Like obviously
I've
we
never
could come up with one or two of them. Like if you were working and then stopped working or something.
Yeah,
crazy
I've
like
not
that,
had it happen in the wild. I can tell you that. But it could conceivably.
Yes, for sure. Also along those lines, there are a couple of different life expectancy tables. And so if you have a spouse that is greater than 10 years younger than you, am I getting that right?
Yes, I believe so.
There's a different life expectancy table for you, which actually reduces your RMD amount by a little bit. Certainly probably not worth going out and marrying someone 10 years younger than you. Just for
No, I have a couple of households that fall into that situation, and it is a slight difference in the RMD, but it's not enough to change your love life over.
But something again, it comes up every once in a while. Make sure you're paying attention to it because you don't want to take out more than you need to if you don't have to, right?
Right.
So kind of relating this back to state of Michigan, what is and isn't subject to RMDs, I think is another big point.
Yes.
You want to go through that for us?
So RMDs only apply to pre-tax retirement accounts, which would be traditional IRAs, traditional 401ks, traditional 457 contributions, and 403bs too, which doesn't really apply to the state of Michigan folks. Does not apply to any Roth IRAs or the newer Roth 401k contributions and the even more new 457 Roth contributions. Those are not subject to required minimum distributions. And do we want to talk aggregation rules here?
Yeah, before we do that, another weird potential quirk too is if you happen to have some after-tax contributions in your pre-tax plans, this is something that was much more popular before the advent of the Roth options for these. And so occasionally we'll see people with after-tax. So you do still have to take the RMD. It goes into the calculation, but a portion of that RMD related to that would not be taxable, which just complicates more stuff, but something to be aware of.
Yeah, that would be an hour conversation in and of itself, and it's not pretty.
You definitely want to seek out a professional if you've got something like that going on for what your options are and how to kind of think through that. But going back to your point about aggregation rules, I think this is something that sometimes people miss as well.
Yes.
So you want to talk us through that, Dave?
So by aggregation rules, we mean that account types that match, you can add your RMDs together and take them from one account. I think if we're just talking about people that have multiple IRAs, and maybe you have different investments in those IRAs, so maybe one's more liquid than the other, you could take the RMD from two IRAs, add it together, and just take that amount from one. And the IRS is happy with that. So if you had all cash in one and stocks you didn't want to liquidate in the others, something like that, a good investment reason, you can do that. You can also aggregate 403Bs together, but you cannot aggregate 401Ks, and you cannot aggregate between 401Ks and 457s.
Yep.
So a state of Michigan retiree could conceivably have 401k accounts, 457 accounts, and IRAs outside of those accounts. So just be aware, if you do not do a rollover when you retire, when you reach required minimum distribution age, you will have to consider those separately. Take RMDs from your IRAs, take an RMD from a 401k if you have it, and take an RMD from your 457 if you have it.
Yeah, and it definitely, it doesn't necessarily come up too often, other than, when I think about that, I think about complexity, right? Obviously you don't want to have 7 different distributions that you have to take from 7 different accounts, because that can get annoying, and the likelihood of you missing one of those is much greater than if you just had one to take from one account.
Right.
But, depending on your investment selections and things like that, where it does potentially make sense is if you have certain investments in certain accounts and not in other accounts, like thinking through how to make sure you have the liquidity that you need. Like I said, most people generally, especially in the 401k space and 457 space, everything's pretty liquid. But if you're one of those people that decide you want to put everything into longer term stocks in your 401k and keep more bonds in your IRAs, like you don't have the option of not selling some of those stock funds,
and of course,
to cover your RMDs.
Rolling your employer plans, 401ks and 457s into IRAs at retirement does solve for that as well.
Right. Yeah.
We should mention here probably too that if you're still working when you reach required minimum distribution age, you'd be required to take required minimum distributions from IRAs outside of your employer plans. But if you are still working for your employer, you can delay taking required minimum distributions as long as you're still working.
So that's another thing to think about, especially like you said, if you are still working and you want to delay those RMDs, and if the VOIA plan allows, which I believe they do, of moving money in, you can kind of play that game too of what makes sense, what doesn't make sense. Do I need this distribution? But another planning point of looking at, where things are and how that RMD impacts you.
Well, and that's a tool that we like actually in this case, because we're able to invest pretty much how we would like to invest in an IRA inside the state of Michigan VOIA plan. So there's not a lot nowadays. There's not a lot of investment difference if someone can save the taxes.
Right.
Now that's a whole nother discussion too, of whether you
defer
want
to
defer the taxes further, because you're right. I shouldn't have said saved. I should have said deferred. At some point you have to pay them, and it may make sense to take them and pay them, while you're still working, depending on where you're going to fall for tax brackets and things. Tax planning and strategy there is another in-depth,
Yeah.
nebulous
And I
topic.
think, again, we talked about it a little bit earlier, but one of the biggest things to get out of this is like sit down and do the tax planning and figure out where
Right.
you're at now, where you're going to be at in the future, because even if you can get around taking an RMD at 73 doesn't mean it's going to be the best thing for you in the long term.
Yes. And I think maybe that's a good segue into the fact that, Roth conversions and making Roth contributions in your later years while you're working can help make RMDs less.
Right.
All tongue-tied this morning. But if you convert money from a pre-tax account into a Roth account, then you have diminished what your future required minimum distributions will look like. It's one of the big reasons for doing it.
Yep. So one thing to note about that strategy, unfortunately, you can't take your required minimum distribution and convert it. It does have to go as a distribution to you. But if you are not RMD age, and one of the big strategies that we look at, if, generally most people aren't working past 73. And so, if you're retiring at 65, you've got 8 years to kind of figure out where you're going to be now, what your impact of RMDs are. And so if you're going to be in a higher tax bracket in the future, especially as your RMDs push you up, you might want to do some conversions, take some of that and pay taxes on it now to lower your RMD in the future. And so there's definitely strategies around that you should be thinking about in terms of how does this impact my future? And does it make more sense for me to pay some taxes and convert it now?
Much more eloquently stated than what I was trying to say. Thank you. It's that kind of morning.
Well, that's the beauty of you and I tag teaming, because there's going to be people out there that thought your explanation was better than mine and vice versa. And then the other thing, so those are some strategies before RMDs. What about strategies after you hit RMD age, Dave?
Well, after you've reached RMD age, after RMDs begin, you can do qualified charitable distributions, which count against your required minimum distribution, but do not count and are not taxed as income to you if you follow the rules correctly. That you have to do those from an IRA rather than from a 401k or 457. So at least some of your money would need to be rolled over for that to work. Interesting little twist there. And I think this trips people up. I think it still trips up advisors. Those used to start. It used to be that required minimum distributions started at age 70 and a half, and you were able to do qualified charitable distributions at 70 and a half. They left that age at 70 and a half. So you can actually strategically, a couple of years before required minimum distributions start, if you're charitably inclined, make IRA charitable distributions ahead of time, which will then, again, because your account balance will be lower when you reach 73 or 74 or 75, help with that portion of your taxes. And then throughout retirement, once you're eligible for those, you can actually do right now. They change it for inflation every year. Is it 111,000 this year?
Yeah, at least 100. I don't know exactly what the change is.
It started at 100. I believe it was 109 last year. It's a lot.
Yeah,
it's a lot. And so, but that would, if you don't need your IRA, don't need the required minimum income, then that's a good way to reduce your taxes and put them to good use.
Absolutely. Especially if you're already making some of those charitable contributions, because with some of the law changes with the higher standard deduction, not a lot of people are deducting those on their taxes, but they're still making them. And so here's a way for you to actually get that tax deduction and maintain your higher standard deduction, which is really good.
And I know we've recorded whole podcasts on that topic, but our general rule of thumb for our clients is don't write a check to charity, talk to us first.
Yeah.
Because generally they're, while, we're all about giving for the sake of giving and not necessarily for the tax deduction. Usually the least efficient thing you can do is write a check to charity.
Very true. And from the charity standpoint, whether you write them a check or whether the custodian does it from your IRA, they both cash.
Happy.
They don't pay taxes on
it. They're happy. So,
Yeah. One of my favorite things about the law change is we finally got away from those stupid half years, except for
that one.
PTs.
Yeah. Well, and a lot of those half years, it used to be the calendar year where you turn 70 and a half. With that one, it has to be after your 70 and a half birthday. It's again, there we go, applying logic to the tax code, which is always an error.
If it did verify, it looks like you were correct for 2026, 111,000.
So, all right. I'm back on track for the day. There we go.
So I think in kind of just wrapping it up a little bit, Dave, just some common mistakes that our listeners want to be wary of. And the biggest one is missing those RMD deadlines.
Right.
There's been some change with the change of ages to reduce those penalties, although they're still steep. And the other part of that, which we talked about before, is they used to be 50%, but literally nobody ever ended up paying it.
Right.
But now that they're lower, it is kind of one of those things where we assume that the IRS will actually assess those penalties.
So what Nick's getting at is it used to be pretty easy to get out of it by claiming it was an administrative error.
Right.
And in my entire career, I've never seen anyone actually pay the penalty, despite seeing maybe a half dozen cases where people didn't take them on time.
Yeah, as long as you found it and told the IRS about it and took it out, usually you were good with it.
I have not seen that tested since the rules changed, but I think that's a fair assumption. The penalty is lower, but they'll probably make everyone pay it.
Yeah. So definitely something to keep track of, making sure you are taking those out. And the rule is it doesn't matter when you take it out in the year, as long as you take it out before December 31st, other than your first year, which we had already talked about.
We addressed. Yeah.
And for a lot of people, it generally ends up being, I would say the majority of my clients take it out later in the year, usually around December or so, just kind of with the philosophy that the market's generally up.
Yeah.
But a lot of them take it earlier or spread it out throughout the year, just depending on how and when they're using it. So everybody's a little bit different there.
The IRS doesn't care how you take it. We've got clients who take it monthly, clients who take it in chunks every now and then. Some clients who do both. They'll take a monthly amount out of their IRA, like a paycheck, and then true it up to meet the required minimum distribution later in the year. I would add as an asterisk under that, treating the required minimum distribution as a maximum. We've got folks that think that's all they can take.
Yeah.
And while it's a safe number generally, because it starts out less than 4%, and we've talked about the 4% rule of thumb for distributions as being a safe number. If you just take the required minimum, we generally don't have to worry about anybody running out of money, right?
Right.
But on the other hand, I think it does contribute to the underspending problem we see with some retirees, that they just kind of focus on, well, I took my required minimum already, so I shouldn't take any more out of my IRA this year.
Right. Yeah.
So,
for sure. So another thing to pay attention to is, because these distributions are, for the most part, 100% taxable to you, making sure that you understand the withholding rules and you're withholding enough, especially if you're one of those people that aren't taking distributions from your IRA, and then all of a sudden you have to start. And if you took a $50,000 distribution, didn't withhold any taxes, chances are you're going to be way low on your tax withholding, which means you're probably going to potentially be subject to IRS under withholding penalties. So making sure you kind of dial those in. And that's another thing that some people don't realize, but if you're taking a distribution from an IRA, you do get to set what your withholding is for both federal and state of Michigan, which
in general is a lot easier. We don't have to do a W-4, explain, story problem, explain your situation. We can generally just say withhold 20%, withhold 15%. And we do actually have some folks where we'll change it during the year as things change. So, but to Nick's point, just be aware that, especially that first year, make sure that you're not going to put yourself in a pickle as far as under withholding, and have that.
And sometimes people get a little bit confused about that, but it generally works like your paycheck, right? Like their custodian is sending that money to the IRS, just like your employer was sending it to the IRS on your behalf. So that
I mean, Our usual operating procedure when someone needs money from their IRA, we don't ask them how much gross. We ask them how much they need in their bank account, right, and then we'll figure out like the gross and the withholding on top of that.
Yeah, absolutely. And that, that withholding counts as part of your overall, right? So if you have, right, 50,000 and you send 5 to the IRS and you get 45, you've satisfied, yep, the 50,000 too.
Absolutely.
Another common mistake, forgetting old accounts. So, yeah, if you've got a long lost yes, IRA or something along those lines, or an old 401k plan somewhere, like, you are still required to take that. So
more than once in my career, and this is specific to the state of Michigan plan, we've called Voya and given them the social security number of the person where we would, yeah, like get the, and they're like, well, what about this account? And it'll be like I had somebody who had substitute taught for a while, like during college, and had money, yeah, in the state of Michigan, yeah, plan from that in a separate account than their right, 401k as a state employee. And it was like, we're not talking like hundreds of thousands of dollars here. We're talking barely thousands of dollars, but just be aware that those things can be out there, and you don't want to find out by missing an RMD, yeah, and having the IRS, right, tell you owe a penalty on an account you didn't, yeah, know existed.
You find, yeah, it when you're 80 and you've missed 7 years of distributions,
right,
and
right, pay penalties and interest.
Figure that out.
Yeah.
And then we talked about this. We talked about a couple of these earlier. We'll just kind of briefly talk about them again. But IRAs versus 401k 457 for QCDs. Again, those, yeah, have to come out of IRAs. So if you're, yep, thinking about doing that strategy, making sure you're rolling enough of that, yep, into an IRA, yep, to do that strategy. And then the aggregation rules, again, like we talked about, yeah, you can't just take everything out of your IRA. If you have 401ks 457s, they have to come out separately.
I would add, as a big overall common mistake, is not thinking about required minimum distributions until you're there. And this happens quite often. And, state of Michigan employees, at least traditionally, have retired reasonably young, a lot of times in early 60s, depending on the role. And, that's a great opportunity to strategically think ahead 10 years. Like, hey, if I do, a $10,000 Roth conversion every year for the next 10 years, what does that do? Or what, and think, I'm making numbers up there, obviously, but, think about like how that changes your taxes early in retirement versus what that would look like if you just left that in the pre-tax account growing to pay required minimum distributions on in your 70s.
Right. Yeah. And I think the flip side to that too, Dave, great point, by the way. But the other side of that too is like in your working years, I generally wouldn't worry about it too much. Like if you're 40 in your peak earning years, you don't need to be like thinking about, well, my RMD is going to be so big, I need to do a conversion, because like you said, depending on when you're going to retire, you're probably going to have a pretty good window to do a lot of that planning. You don't necessarily need to do it when you're in your peak earning years at 40. Everybody's situation is different, but I get calls from people occasionally where they're like all super worried about this thing that's going to happen to them in 30 years. And it's like, okay.
Well, and we've also seen, headlines in the financial media about the coming, you beware the tax bomb, or beware the required minimum torpedo that's going to ruin your retirement. It's like, no, you put that money in there, and you're going to yes, someday you need to take some of it out and spend it. That's what it was for.
Yeah. And pay taxes on
it. Right. And you're still further ahead for having tax deferred growth through like 40 or 50 years of good markets. I guess, advisors play into that to a certain degree, trying to get people excited about things in the media. RMDs are annoying. It'd be nicer if we could just be free to do what we want, but they're not the end of the world.
Yeah. Well, everybody's got a little bit different philosophy around, taxes and paying taxes and, trying to avoid taxes at all costs. And, there's pros and cons to both of those strategies. And I think the biggest thing is just working with someone that can help you with the tax planning, that you can figure out your strategy, because the other side of it too is, it's really difficult to make a tax decision today thinking about what might be in 30 years the future tax situation, right? Like, there's just too many variables in that where maybe you're right, maybe you're wrong, but you'll never know until 30 years from now. And that's a long time to wait.
Right. Yeah. You're not going to get a detailed answer from either of us looking out that far. We know better.
Especially in like an all or none situation where
I mean, that's what I was going to say next. We can help you figure out the trajectory, but not necessarily the details.
Well, and that's the problem with, the tax bomb and, pay all your taxes now, pay no taxes in retirement like that. That's
and if you had done that early in my career, I can't remember when you started relative to when the first big tax, like, I think of like 2003 when the brackets started to get adjusted down.
Right.
If you'd done that in 2000, you'd have paid a whole bunch of tax, when you might have been in the 22% tax bracket now instead of the 32. I don't remember what they were, honestly.
Yeah.
It was steeper and higher.
Right, for sure. Well, with that, Dave, appreciate you and your insight today. If our listeners have any questions, feel free to reach out to us at info@srbadvisors.com. And as always, have a great day.
Thanks, Nick.
Thank you for joining us for another chat about your retirement and finances. Please hit that subscribe button. You can also contact us at srbadvisors.com or email us at info@srbadvisors.com. See you next time on Kitchen Table Finance.